Welcome to today's edition of The Rundown. So today we wanted to talk about finding your level of risk. Essentially, how much risk should we be taking on in your portfolio as it relates to your investments? We think it's a pretty in-depth conversation. It's definitely far more than just filling out questions in a worksheet, a questionnaire that says once we total all these up, we'll determine whether you should be aggressive or moderate or conservative in your portfolio. We think it's a much more in-depth conversation than that, and it's something that evolves over time. We learn more over time what an appropriate level of risk is, and it's adaptive too. Things will change as time proceeds on. But so how do we find that level of risk? Well, questionnaires do get to one of the kind of the foundations of risk, which is time or time horizon. You'll hear a lot. Basically, leading up to retirement, and typically we're talking about retirement assets. Leading up to retirement, how much time do we have? And then in retirement, how do we make sure that we don't outlive our money? Those are kind of the two time pieces that we focus on. Obviously, leading up to retirement, the longer you have until retirement, the more, in theory, the more aggressive you should be, because that will lead to, over time, in theory, quite a bit more assets because of the compounding effect. And we'll talk about compounding another time in one of our Wealth 101 episodes. But so prior to retirement, more risk. When we talk about in retirement, now we're talking about distribution. We're not talking about growing assets anymore. We're talking about making sure your money lasts and how we're distributing assets. So time becomes the building block. What we like to focus on is goals, but one thing we like to get out of the way because it gives us at least monetary amounts that we have to have. That's budget. How much debt do you have? What are your basic fixed living expenses? All those different things that you just can't go without. And certainly, we want you living off of more than just, ramen noodles and hot dogs, obviously. What are those living expenses? And then we can start to have the conversation about goals. So obviously this sounds more like a financial planning conversation. But it really is, because financial planning is going to determine the level of risk that you should take on. Because let's talk about the distribution side. If you have certain goals in retirement, we can kind of put a number on those goals, so we can back our way in to a dollar amount that we need to save up to. So if we know how much money we're making, we know what our salary is, we know how much our living expenses are, and we have this dollar amount in mind, do we have enough to just save those assets outright? Or do we have to take risk in a portfolio so that compounding effect can help us build those assets? And if that number is higher, do we have to take on more risk? And then the same thing as well when we alluded to distributions. If we have all of these various financial goals, or necessities maybe, if those are higher, we may have to distribute more out of your pool, your investment account. We might have to take more as a percentage out. The rule of thumb typically in retirement, and this is kind of the way you can back your way into that retirement number, is 4 to 5%. If you can distribute 4 to 5%, why do they say that? You can be relatively conservative. So in theory, you're conservative, you're returning slightly better than 4 or 5% return, so your money continues to last throughout retirement, and it might actually grow a little bit in retirement. So again, like I said, if your goals or if your needs are higher than that rate, we might have to take on more risk in the portfolio to get a longer term average, longer term return. So if 5% return doesn't cut it, because let's say your goal is to leave some money behind, or maybe your rate is high enough that we can actually calculate the years. If we average a certain rate of return that we won't have any money left, we need to change the risk level there. So goals can really play a big role in us determining how much risk you need to take on to kind of meet all of those different monetary requirements. That's all kind of the nuts and bolts, the more honestly the easier part to figure out, because it really does just come down to the numbers, and can we make the numbers work by adjusting risk and things like that. The other piece that we need to focus on too is your comfort level. Are you comfortable with those levels of risk that we're saying that we need to take on, or maybe not take on? Are you comfortable with that? And we're coming out of a time that can be really telling and can help us kind of look inwardly and find out if we really truly were comfortable with the level of risk that we're taking on. In these downturns like we just had in the pandemic. Obviously this is a pretty big downturn, and we've had a good rebound, but were you comfortable with that? Or did you have that emotional push that said, oh, we really should I really don't want to be in the market, I want to get out? Do you have those urges that are kind of pushing you to make a financial decision based on more of an emotional feeling? Because our goal is to find a level of risk that meets those goals but eliminates the emotional side of investing. We want to maintain as an objective approach as possible, because we know that over time we need to stay invested to meet those long-term goals, because we need to average certain returns over time to do that. If we're averaging lower than what your distribution rate is, then we know that we're going to run out of money at some point. You can't take 6% out of your account and only return 2% and expect the money to last forever. I mean, that math just doesn't work. So we know that it's important to get the appropriate level of risk so that we can stay in the market and meet those goals. And if the risk isn't, or it doesn't feel like it's appropriate, there are those emotional urges, then maybe the financial planning side, maybe those goals need to change a little bit. So again, like I alluded to before, it's an adaptive and it's an evolving conversation, and there's a lot more than just a little simple worksheet that goes into determining the level of risk that you should take on. But so that's what we're here for. We're here to help you through that process and determine how much risk should be in the portfolio, and how do we not convince ourselves, but how do we make sure that we stay invested at that level of risk so that we can meet those goals that we've planned for over the longer term. And we'll go a little bit deeper into things like the importance of staying in the market, and looking at those numbers as well, and why we can push that as a key factor in developing these financial plans. So hopefully that sheds a little bit of light on what we're doing in order to find level of risk and fine-tune level of risk in a portfolio. So thanks so much for watching. We hope you stay safe, be smart, and we really would love to see you soon.